All right, so today I have got Jonathan Charles Tyler with me on the podcast. He is quite a veteran in the PE and M&A space. He has more than 25 years of experience. He is currently working as managing director at Vortex Capital, which is a global spanning M&A boutique capital advisory firm. So yeah, I'm super excited to have you on, Jonathan.
Thank you very much. Glad to be here.
Why don't we start with like a brief introduction as to what you do at Vortex?
Sure. So Vortex is a niche player in the market. We cater to the middle to lower market segment, and we specialize in capital raising. So both equity capital markets and debt capital markets. The unique thing about Vortex is there's a network in Switzerland, in the UK, and in the US that does client relationships. So what you're really getting is experienced ex-bankers, investment bankers, with the old Rolodex and investor network that is able to connect clients who are looking to raise capital, either equity or debt capital, in the markets. We've got various teams that are sector specific. So my sector at the moment is energy, which I think is very important with AI going, and Bitcoin mining. Infrastructure, which is also something that's very interesting to me. And obviously I hail from originally South Africa, so commodities. I'm very, very well versed in commodity deals and how to get those up and running and funded. So commodity deals, if you don't know, is very capital intensive. So commodity companies are always looking at expanding the production. There's a big difference between finding a resource in the ground and getting the resource out of the ground into the market. That takes a lot of money and effort and a lot of risk. So we always find that there's always an investment into commodities that's needed, and always investors into commodities. And it's also quite a long lead time in terms of the production of metals, the processing of metals and commodities to get to market. And it's very relevant nowadays that we've got the rare earths and the strategic minerals as well that are coming to market. So as we kind of go into the new world, we still find that we need the commodities, the rare earths, the lithiums for solar, for renewable energy, for catalytic converters, platinum is very, very important. Things like that are still coming up, and we're still manufacturing, cars, vanadium, those type of things are very, very relevant still. So we need to still produce, and Africa is one of the largest producers of commodity resources. So I've got a lot of experience in that. So Vortex looks at taking clients and connecting them with the capital markets. Kind of we're like the middleware or the middleman in the market, where we are looking for clients who we find are looking to connect with capital and bringing them on board. So sometimes we'll look at raising capital in the US market, if that's a listing. The old traditional way of raising equity is an IPO, or the reverse takeovers on listed bourses and stock exchanges, to finding family offices, venture capital firms, private equity, who then will exit with a potential listing. And then on the debt side of things, we'll go and look at institutional capital markets, depending on how far dated the debt is. So if it's short dated, it's normally institutional asset management firms. Longer dated is normally insurance companies and pension funds who are looking at longer dated liabilities to do their asset liability matching. And that's what Vortex kind of looks for, is a client that's that wants to come to market, wants to expand in the US market. And that doesn't necessarily mean that they've had any experience there. We're happy to introduce our clients to the US market going forward and raise capital, where I think really it's things are still happening in the US. It's one of those areas where I find that capital across the capital stack, if you look at the capital stack from equity all the way to debt, you still find that the US market is very open to raising capital in all areas of the capital stack. I sometimes find that in Europe there's a very few or limited pool of kind of really good venture capital or really early stage capital development, where in the US you still find lots of available capital, especially in the private credit market now as well.
Yeah. Do you think what do you think that is? Do you think it's like just Europeans being less or more risk averse, or is it just the US market that's more evolved in that sense?
No, I think it's scale. So one has to remember where I am in Miami, Florida, for example, that that Florida is quite a large economy as GDP. I think it would be one of the G10 if it was a country. So it's got a comparable GDP of the UK. So from a scale point of view, the whole of Florida, and that's North and South Florida, is
Which
quite a
is
big, huge
insane in itself.
economy. And Florida is not even the big state. So I think there is probably, of the 50 states, the last, from 40 to 43, the last 7 states are kind of in the same GDP as some of the European companies. So it's scale. So you get a lot more people, a lot more money, a lot more dollars available. Secondly, I do think that the Europeans slightly are more risk averse, but I don't think it's more that. It's the US investor asks questions and comes to decisions a lot quicker than the Europeans. So I used to work at Barclays Capital for my sins, and when I was speaking to European clients, it was very much there is a regulatory and compliance issue that needs to be checked, and there's a lot of legal documentation. That happens in the US, but the decision to do a deal comes a lot quicker. So there's a lot more, the due diligence is very similar. In fact, the US has got a lot of regulations and a lot of due diligence as well that needs to happen. But the decision-making process maybe at the upper levels of whether to do a deal and pull the trigger is a lot quicker maybe in the US than it is in Europe. That's what I found. Secondly, I think the financial institutions in Europe are the banking situation there is they're very much set up to be income lenders. So if you've got a balance sheet and you're producing income, they look at the strength of your cash flows and they cash flow lend against your income statement. There are very, very few people that look at capital lending, which is the balance sheet side of things. And there are very few people that if you don't have an income and the ability to kind of pay back loans, then it's very difficult for them to fund or take a position. Whereas there are capital providers in the US that will take a risk in terms of new capital ventures where it's pre-revenue. And that's where's the most difficult capital raise, pre-revenue, but you've got a big idea and it could be very, very big one day. Now those are exactly how the tech entrepreneurs were able to get their big ideas across. But it's very, very small market as well, and it's a very niche market.
Actually, then getting, if it sounds like that's, relatively big part of your, or the pocket that you found in the market is also being able to help companies or European companies actually, raise funds from the US. Is that does those types of companies typically find you, or is it something that what's your approach to actually getting in contact and finding those companies that are in a situation where that makes sense for them?
Yeah, I think, what do they say? Capital has no boundaries, and good deals are always going to be good deals, no matter which side of the pond you're on. But sometimes you have very, very good ideas in Europe, and they struggle to find the growth phase. And because I said the first thing that we talked about was scalability and the size of the economy, there's more space. So I find that in Europe there's a winner-takes-all mentality. There can only be one company, and it kind of crowds out the competitors. Whereas because you've got such a big economy and a big theatre in the US, 50 different states, each one, you can have 50 different companies that are champions at what they do. So, for example, you'll find that you'll have one large chemical manufacturer in Germany and kind of the EU, and dominates the whole of the EU. Whereas in the US, you can have each state having a chemical manufacturing that's doing really, really good business and making a lot of money. So that scale is the issue. So in terms of finding clients, the client acquisition is always a difficult part. It's really about getting your message out there and showing your ability to what you can do for clients. But yeah, we rely on marketing, obviously, sales and marketing. We have nowadays, it used to be when I was first started in the financial markets almost 20, 30 years ago, it used to be very much boardroom meetings, people coming to your offices, having really nice fancy offices with wooden, paneling and nice artwork and very impressive for clients, and
Missed that.
bringing them in. then having, kind of lunches and going to really nice restaurants and entertaining clients. And then, there will be conferences, things like that. The conference circuit still happens, but to a lesser extent. Now in the digital age, things have changed. So it's being on podcasts, it's being able to find AI scrapers, using client acquisitions, looking at LinkedIn. Hit me up on LinkedIn if you've got deals for Europeans who want to come to the US. Getting your kind of brand out there. So the Vortex brand, getting it out there, getting it known, looking for clients who come to you. So it's always a development where you're trying to look for clients. But definitely the digital age has changed how things work. And the digital age has made things, I suppose, a lot easier for clients to find people like me and Vortex. But still, there are a lot more players out there in the market. So it can be quite a confusing market about exactly who to appoint if you're a client and what you're trying to get out of the client interaction. So, for example, there are a lot of players that purport to be something else and they're not. So it's very difficult to find a reputable player, somebody that's got the experience and the ability to do deals.
How do you think about the part of actually standing out in a marketplace where it has evolved to probably like 20 years ago, it was, someone who knows someone. And I guess that's still like a lot of deals still happen that way. But now it's also, searching up on Google or, wherever it might be, where you suddenly have 100 different options that it's hard to actually see what are the primary differences between the different ones. How do you, like at Vortex, think about standing out? Is it the specificity of, we have access in all of these different markets?
I think it's great, actually. So when I was at investment banking, you had to be at one of the big, well-known brands, the Goldman Sachs, the JPs, the Barclays, if you wanted to get a deal done. And that kind of dominated and crowded out the market. Now with the advent of AI, scrapers and agents and kind of sales agents that can work for you and trawling, LinkedIn, now it's possible for middle-sized companies like Vortex to actually compete directly, almost head-on, with the old school JP Morgan banker closed network. Now, as you say, that kind of upper echelon of, chairmen of Lloyd's Bank speaking to the senior bankers at a British institution, that still exists. It's a long-standing relationship. Those relationships don't disappear overnight. But it does mean that Vortex is able to compete for clients and find investment banking opportunities in the market like it never used to do. So I find it quite refreshing because it allows you to kind of have more choice in the market. So you don't have to go to the usual suspects and those top banks, and they don't get all the deals now. Certainly if it's if you're sitting at one of the large banks and if the deal size is too small, it doesn't really make your kind of budget and it doesn't move the dial for you. So you're not really that enthusiastic about a smaller 10, 15, $20 million client because you have to do so many of those to kind of achieve your budget. You'd rather do 2 or 3 lunches with a chairman of the board and get a big £1 billion deal happening, and you don't have to worry about anything for the rest of the year. I'm just saying. But for us, smaller guys, we actually like that because I like doing deals. So the more deals you do, the better it is. You always find new things out. Every deal is different. And we're able to do 10, 15, 20, $25 million deals, and we still are able to be competitive because we've got lower overheads now. So you don't have all the regulatory kind of aspects as a large, big banks. They're pretty much like oil tankers and we're like a speedboat, so we can kind of pivot quite quickly. But yeah, I find it quite refreshing that the new age of investment banking is upon us, and I'm embracing it. We're still trying to figure it out. I think we're all trying to figure out the right channels to kind of speak to and get the clients. But certainly those, the old legacy banks, let's just say, or the legacy network systems still exist, but they're finding it very difficult to go on competing. And I think small companies like us are able to come to the party and certainly be more dynamic, maybe give you more direct attention, and certainly be more passionate and more focused on delivery as opposed to the larger brands that are out there in the market. And I think that's refreshing from the client's point of view, as well as the investor's point of view, that they've got more choice available.
Yeah.
And it's more competition for everybody. So I think that's a good thing. Again, from the client's point of view, you need to do your homework. You need to educate yourself. You need to find out who's good and who's not in the market. It's kind of, you need to do your due diligence on who you appoint. And that's one of the things that can be confusing now from a client point of view. If you've got so much choice, you need to kind of find the right partners to partner with. And it's always kind of comes down to these type of interactions. If you find somebody that you resonate with, use that, because it's something that's rare in the modern world.
Yeah, in the modern world, for sure. Like, it feels like it's becoming more and more rare as well. Are there any specific markets that you're seeing move especially fast right now, or find especially interesting? You mentioned like commodities and like rare earths and mining. Are there, like, is that the primary one that you're going after? Is that also just because you have a years of experience in that?
I think there's strategic deals which are kind of everybody's interested in. So there was the whole data centers with AR. That was very topical, and then people realized what the downstream implications of building data centers is, which is you need a lot of energy. And then if you're pulling a lot of energy from the grid, that increases the kind of electrical capacity on the grid and demand, which increases prices for ordinary consumers. So you find that your energy costs will all of a sudden go up because you're trying to compete in the global market for AI queries, which everybody says is the next big thing, right? So you've got ChatGPT, video calls. In fact, everything is compute now. Everything is energy that is being used to drive video conferencing, Google searches, LinkedIn searches, AI queries. Literally, and it's going to be bigger and bigger and bigger, right? So there's a huge demand for energy, right? But that drives up the cost of energy to the average person, firstly, because there's not enough grid capacity. So building out the energy is one of the big kind of areas of growth that's going to go forward. So a lot of investors see that. Second thing is to push the energy kind of to the next level, you're going to need raw materials. Raw materials are used in manufacturing of silicon panels, PV cells, solar, renewable energy. Those wind turbines are specialized metal. So a lot of rare earths are happening for that. Then again, we're also looking at the defense sector. They also look at rare earth minerals for a lot of their components that they use. So there's a big build out, and when you're talking about increasing GDPs from the current spend in Europe of 0.5 to 1% to 5% of GDP, that's a lot of money going to defense spending, which means a lot of procurement and factories, and they're going to be needing a lot of raw materials, which is iron, steel, all the things that go into making the military hardware that they want to build out in NATO now going forward. So those are kind of thematic investment sides where investors are looking. The other one is, everybody was betting a lot a couple of years ago, and it became a lot easier to do SaaS, software as a service businesses. And there was a lot of money being made in unicorn businesses which are software driven. And now we see that AI can replicate a lot of these businesses in an afternoon. I know one person that had run a company with software, and somebody came out and looked at his software offering to the market, to corporates in the marketplace, and was able to, within 2 or 3 days, use Claude coding to replicate what he had done and make it even better. And instantly a new competitor that he thought he had a kind of a moat investing in, there's now somebody that's able to do it quite quickly. So in terms of investor future-proofing their investment, we see that there is a focus back onto doing real, tangible investments into real tangible assets, as opposed to software assets where you can be disrupted by AI in the future.
Yeah, that's actually interesting, because it is something that's just moving extremely fast, and it's crazy how fast it can move. And I guess like some of the older, more traditional sectors like commodities is less likely to be disrupted in the same sense that what we're seeing with software right now. And software is not even that old of a sector or like an industry, or like SaaS specifically. yeah, it's crazy. Like literally the stuff that we've built out within our agency the last just, I don't know, a month with Claude Code has like literally saved us 3 people's man hours and made our operations so much more efficient and so much like more quality control. Because all of these things before, you weren't able to actually build yourself. You'd have to hire a development team. Like I literally got quoted from a developer that, it would take 6 months to build out what I wanted with a pretty like hefty bill with it. And now it's something that I myself, without knowing much about coding, has literally built out in a month. So it's with all of the functionalities that you're able to tweak when you're the person that's going to use it and you're the person that also builds it. So yeah, it's massive, and I think it's only going to be faster and speeding up from here. It's actually interesting that you're then also seeing investors noticing that and already starting to move into the more traditional sectors.
Yeah, I think so I'll caveat that. I think the smart money realizes that if you want a long dated asset or, equity capital for, something that's been built and will be around in the next 5 to 10 years, then you got to see something that's kind of anchored to the real world that's difficult to replicate through AI. But where AI and where the kind of service and software kind of side thing works is where you're looking at AI for applications. So taking an AI agent or an AI application and using it as a real world example and monetizing the AI. So it's not so much as coming up with your own unique coding and developing new codes and software. It's taking the AI that you've got and applying it in new, different, innovative ways. Those are still very, very much sought after. I mean, if you can find those are definitely sellable. And there are people that I see a couple of clients a week where they're taking very innovative approaches in biotech applications where things would take a while to do. You're now speeding up the whole process for biotech, just kind of looking at sampling, let's just say lab results and interpreting lab results, things like that used to take a professional to do. You can do it in AI in minutes, right? You get your lab results in minutes because it's actually sequencing in different genomes. Then you're looking at, just in terms of agriculture as well. AI is being used there. Drones are being used there. Using AI facial recognition, all for security. It's becoming a new world. So those AI applications in software are really what's hot at the moment in that aspect. But again, it's still risky because you don't know how future AI is going to respond and how you're going to be, how long that lifespan is going to be.
Exactly. It's still just something that's so fast-paced that it's very hard to predict how it's going to look even a year from now. Like if you look at a year back just from now, like how different things were with AI and what you were able to do versus what you're able to do now. The curve is not just like steady like this, it's like this. So it's just going faster and faster. It's interesting, but there's definitely a lot of money to be made in that as well. Looking back, that's also the investments and the industries where if you're able to hit those, it is moving really fast.
Yeah, so smart money and investors are always about positioning themselves and trying to anticipate where the market's going. So you'll get the kind of crowd that follows what's really hot now, and that has a limited lifespan. So as I said, data centers, about last year, everybody was doing data centers. They've moved on to now quantum computing. That's now the big kind of buzzword, right? Everybody wants to do that. But at the end of the day, I know and you know that all of this, quantum computing, AI, data centers, and Bitcoin mining relies on one thing, energy. And we can see in the energy pricing and what's happening now geopolitically with oil and gas, that energy is going to be a major, major concern. And whoever can monetize how they make energy and do it cheaply and reliably, and we're looking at about 10 US cents per kilowatt hour, anything that's sustainable and all renewable, under 10 kilowatts per 10 US cents per kilowatt hour, those deals are really, really going to take off because we really need a lot more energy. If you look at how much China's producing, It's way more even than the US. So although the US is energy dependent and it's got a net export of oil and gas, if you look at the future needs going forward, there's not enough energy availability, even with the amount that the US produces in oil and gas going forward. That needs new ways of producing energy. So we're looking at alternative energy sources, and we're looking at new energy resources coming online and developing those. I'll actually be in Houston in June on the US Energy Conference, and one of the things that people are still talking about in the US is oil and gas, because although renewables and solar are very, very important from a point of view where we are, it's not sufficient to get us into the new brave new world of quantum computing or AI. It's just there hasn't been enough energy that's been put on the grid through that. Still insufficient.
So you see it as, it's both new, like innovative ways or approaches or ways of generating energy, but it's also like investing into what we see working now. Like it's actually...
Yes, I'll give you a perfect example. You can use AI to analyze a power grid and come up with ways to do cost saving, reduce the power wattage on a house by looking at surges in electricity or looking at putting components in which will reduce their electrical usage. So AI tools in terms of, let's just say, monitoring energy use and energy kind of leakage and demand and output. For example, if you come home a bit earlier, you put your boiler on, you warm it up, it doesn't draw as much electricity because the demand is already being done for 10 minutes, so it'll draw power slowly as opposed to quickly, which is a power surge. So if you use AI to reduce power surging in your house, you've already cut your bill in, I wouldn't say half, but at least 10-15% down from power surging, which is very, very expensive. Because the way utilities sometimes bills is they look at the peak power surge and they charge that as where you are. So if you can use AI to do that, you're basically minimizing the cost of your electrical bill and you're optimizing the efficiency. On the other hand, you still need to produce the energy. So that's where you go and get the commodity out. The commodity is going to be building the generators that power either the hydrogen or the gas, or in the future, either nuclear or fusion. So I've got a background in physics, so I'm quite passionate about that, and I've looked at some stocks in terms of building out nuclear. The problem with nuclear is it's going to take 10 to 15 years to get online. So we've got this immediate short-term gap of electrical usage and demand, and we don't have a clear path to get there.
It's interesting to see, because it's like the path always shows at some point, like we always sort of get there. So it's interesting to see what actually ends up winning, if it will be, some of the technologies that we already have and know that we just need to invest harder into, or if it's, another disruption with a new way of actually generating energy as well.
Well, I think that what I'm saying is, even if you make a breakthrough, if you've spoken to anybody that's in the research and development field, taking a breakthrough in a lab and then taking it to production and making it commercially available, there's a lag. It takes about 5 to 7 years to do that, right? If you're in the best of times, to build out factories to do that, it's very difficult. So you have to rely on at least for the next short term, 5 years, existing technologies and what you can actually do. So then you're pricing a energy project in what can be delivered and what's available now. I mean, last year we were looking at doing data centers, and China was the major manufacturer of gas generation gas turbines for electricity. And I think during the middle of the year we were looking at funding a couple of clients, and they had drawn down money, and then they were trying to do the projects. And there was actually about a year waiting list for the factories to produce gas turbines for electricity from China. They had like a 1 year waiting list already. That was last year. So they're delivering now from last year's orders. So that's the Chinese manufacturing cycle struggling to keep up with demand of generation turbines. And that's gas turbines. And what people are doing is they're putting gas turbines together with data processing to power the data processing queries that's happening.
Do you see gas turbines as being like, it's actually not something I've heard a lot about. Do you see that as like one of the,
Yeah, gas you can pump. Gas, there's a lot of natural gas in the US still, so it's available. Most of Europe still runs on gas, and it's kind of like a clean alternative from a environmental, although it's not 100% cleaner, I realize that, but it's certainly cleaner than coal and some of the oil, petroleum. So a lot of that gas. And the second thing is they're also betting that if you can use gas, pipelines are pressurized. So going forward, we could always transition to a green helium product and use the same gas infrastructure and gas pipelines, which are pressurized. And then instead of using gas through those pipelines, we can use hydrogen as a fuel source. And you can develop, hydrogen from solar and crack the hydrogen using green hydrogen or even blue hydrogen. So there's different types of hydrogen depending on the environmental impact of manufacturing. And you can basically retool the European kind of gas pipelines for hydrogen to a certain extent. Certainly for transportation of hydrogen, which is the biggest cost factor in hydrogen as a fuel source. So those are kind of the ideas that are floating around in the energy market. But solar is not used for baseline generation. So one of the things that a data processor has to do is it has to be available 24/7. So if it's at night time, even with battery and battery backups at the moment, lithium's quite expensive to produce, and it doubles the cost of a solar factory, a solar project with a BESS battery backup system. So if you're looking at say $1 per kilowatt hour, so if you're looking at say 20 megawatts, you're looking at $20 million, and then you add BESS for 20 megawatt BESS backup, that's a further $20 million. Your project went to $40 million US overnight with battery backup. And then again, the battery backup's not 100%, going to stay fully charged and discharge cycles at night time, depending on usage. So it's got its challenges. So people are using, let's just say gas turbines, other alternative ways of generating electricity.
where do you see like wind or like wind turbines going?
Yeah, wind again is not really fine for baseline. So when I'm talking about baseline, I'm talking about the output is constant and it's 24/7. Now wind moves up and down depending on the gusts of wind. So you have to kind of make sure that the voltage is fine. So both solar and wind have a real problem with the grid in terms of balancing the grid phase. So when you look at the total national grid, I believe this happened in Spain where they have actually done a lot of solar, so much so that if there's a lot of sunlight, there's a push through, because there's no on and off switch. There's a push through into the grid, and they have to switch off coal power stations to regulate the surging in the grid. So you have to manage the kind of pull and the input into the grid. And solar, if the sun's shining, it's just pushing electricity into the grid. And if you've got 90% of your grid on solar, it's pushing and you can't switch it off. It's very difficult to switch off. A solar project, it's just pushing onto the grid the whole time. And then when there's no sun or there's a cloudy day or it's rainy for 2 weeks, then you're not getting that push factor, but you're getting the surging demand. So you need a balancing element, which is what they call base load. And that base load is normally very reliable, very cheap, and it is used to balance the renewable energy.
That's interesting. I have my father works in wind, so in wind turbine, and something like he's talked about for quite a few years now is the like power to X, actually figuring out how do you store the energy that you're able to produce through solar or through wind in a way where you can store it and then actually use it when like either the demand surges or there's no wind, because you need some way of actually doing that to really make it work like at a much larger scale. But that hasn't been that true breakthrough in that
I've seen a lot of energy storage kind of solutions as well, from using geothermal and mine shafts to hydrogen can be one of those. So what you do is use the wind to make hydrogen, and then the hydrogen can be stored either as ammonia or in a pressurized tank. So for example, or you use it as a battery, lithium. But lithium is very much in demand. It's being used in car manufacturing and electric cars, and there's a huge demand for that as well. So now you've got a huge demand. And again, lithium is difficult to get. I talk about the commodities. I was speaking to a geologist I know, and he said if you look at the world's kind of demand for lithium, there's not enough lithium reserves that are known that can literally service the amount of lithium that's needed going forward. So we need to kind of do more lithium exploration, finding more lithium, because lithium is not that plentiful really.
Yeah. Talk about an industry that can like completely break down if lithium, if there's no more lithium.
Well, there are alternatives. You're using sulfur doping. There's different anodes and cathodes you can. So there was one, vanadium is being used as well as alternative to lithium, and they use that in industrial batteries. So there's different ways of doing the same solution. But yeah, talking about bottlenecks and strategic minerals, lithium definitely, as you build out this new economy, you've still got what do they call it, a resource constraint on the supply side.
Yeah, definitely. There's for sure a lot of problems to solve, but it also also creates so many opportunities. So interesting time.
Yeah, and we're seeing still there's a lot of we also were talking about clients are coming from Europe into the US because there's a lot more venture capital money, there's a lot more private equity money, there's a lot more family office money that's potentially in the US. But there's also a lot more demand for kind of sustainable energy projects in Europe than there is in the US. So the US is very much still looking at large-scale infrastructure projects and large-scale energy projects, where in Europe there's funding for kind of renewable. There's still a lot of funding for renewable energy, and that's the path that Europe's going down. So there are investors that will look at funding US projects here, where the US is kind of still fixated on cost and scale. So which is why they're looking at oil and gas still. I also believe it's the political climate in the US with the different administrations, let's to say, and different focuses. So previously there was tax subsidies for solar projects in the US, and that's kind of being done away with now in the new administration. But that's fine because most solar projects are sweetener, but the way the projects have gone now, you don't really need subsidization as much as you did 5-10 years ago. Most of these projects, if you look at the blended rate and you amortize it over 10-20 years, they are fairly cost effective.
Actually, we used to work with a lot of solar companies, like commercial solar, reaching out to manufacturing plants, etc. Probably 2 years back, 80% of our client base was actually that. And then, all of these new, Trump essentially came in, and all of these political aspects of it literally just broke it down from over a few months, where we used to be able to generate a lot of demand and a lot of interest from all of these manufacturers, to almost dead silence for 4 months until it had sort of settled. So politics is definitely an aspect to this as well. That is probably a good thing to consider.
There was definitely a flurry of activity at the end of last year to get solar projects in before those subsidies, state subsidies, kind of ran out.
Yeah,
so
exactly.
Yeah, absolutely. So geopolitics and politics, so the way the world is and the way politicians react to it definitely shapes where the money flow is.
Mm-hmm.
But that doesn't mean that there isn't pockets of money available for clients that are looking at, as the cycle turns. So as they say, as things go up, they must come down. Cycles turn, investment cycles turn, commodity cycles turn, energy cycles turn. At the moment, what I'm saying is energy is very, very relevant. Commodities are going to be increasingly more topical as we realize that the supply gap in bringing that there. And we're still seeing AI is definitely in demand. Quantum computing is definitely in demand. Defense, obviously, with the political climate where it is now, there's definitely a demand for defense kind of investment. So that's what the investor side is seeing. I'm seeing still lots of interesting deals, from agriculture, from biotech, from human supplementation. It's another one that I kind of find very interesting, is all the changes that they've done in human supplementation in terms of additives and wellness products. it's very, very big now. Everybody wants to live forever.
Yeah, exactly. There's quite a few industries and sectors that are also evolving.
The nice thing about the US, I'd say, is if you've got a product and you want to scale it, it's also got a very, very big retail base. So if you've got a retail product and you want to come to the US, the investors are here because they realize if you look at your business case and you put it into a model, if you're just covering a state, it really, really blows out. So if you make it here in one state and you've got 50 other states to go to, it's really easy from one state to another to kind of, take your product and kind of do a nationwide, distribution. Whereas in Europe, it's slightly a bit more technical. The market sizing and sampling might be smaller. It's really good to show that the market can take your product from a testing point of view. But to get scale across Europe is difficult. You'll find regional reasons why the market doesn't change. For example, don't want to say anything, but there are certain products that resonate in Germany but not in Spain. There's certain products that do really well in France but not in the UK. There's certain wines that France makes that does really well everywhere, but there's competitors. In the US, everybody drinks Californian wines. We all know where it comes from, and it's distributed across the whole US.
Yeah, I guess there is less nuances as well to actually go from state to state. Jonathan, it has been an absolute pleasure to have you on. I have learned so much, and I hope whoever is watching actually sure they have as well. If they wanted to follow along or reach out, what would be the to do so?
Yeah, I'll go to the Vortex website, my LinkedIn page. You can look for me on LinkedIn, or vortex.io is the website. Or based in the US, if you're looking to connect with me to raise capital in the US market through Vortex Capital, be lovely to have a schedule a call with you. As I said, drop me a line on LinkedIn, probably be the best. Otherwise, the Vortex Capital site is vortexcapital.io.
Amazing. Perfect.
All right.
Absolute pleasure. Have
Thank you. You too. Keep well.